Welcome to another episode of Quest for Twice. Today is May 10th. Last week, quite a few companies in my portfolio reported earnings, so I was quite busy to digest the new information. Today, I'm going to review a number of their earning updates. The first one is ATKR. So ATKR delivered another outstanding quarter. Its fiscal Q2 EBITDA was $360 million, comparing to $293 million in the first quarter and the last quarter of fiscal 2021. To put it in perspective, if we look at the top right chart, before the pandemic, ATKR's whole year EBITDA was less than $350 million. So in the last quarter, ATKR made more than its whole year before the pandemic. That's how amazing it is. So let's dig into the numbers and to digest the information better. So let's look at the table and the revenue and margins by segment. Its electrical segment had a record high sales at $760 million and maintained its historical high margin of 43.6%. So again, the electrical segment was carrying more than its own weight. However, the mechanical segment also did very well. Its sales of $224 million almost matched the record in the Q4 2021. The segment EBITDA margin of 12.9% also almost matched the 13% margin achieved in Q4 2021. So the total sales in that quarter was $983 million, almost a billion, and that's a historically high mark. And also almost a historically high margin. So no wonder its Q2 EBITDA was making a record. ATKR also gave an outlook for fiscal Q3 of EBITDA around $330 million. So that's a slight moderation from Q2, but it is still a historically very high number. And the implied EBITDA in Q4 is around $310 million. That would be the third best quarterly EBITDA on record. Probably it's very interesting to look at the annual EBITDA and the outlook, how that evolved. In February of 2021, ATKR gave an outlook for fiscal 2022 EBITDA around $400 million, as shown at the bottom of this table. Then the outlook was gradually raised in each quarter to about $450 million, then above $500 million, and then at the end of last fiscal year, it was about $650 to $700 million. Then up again after fiscal Q1 2022 to almost $900 million. Now, after 2 quarters in this fiscal year, the outlook is more than $1.3 billion. That's just simply amazing. ATKR also gave an early outlook for fiscal 2023. EBITDA will be around $800 to $900 million, so close to $1 billion. The thinking behind was price and margin will normalize, but still the timing is uncertain. But the company has seen enough on its backlog to make that prediction pretty confidently. And given ATKR management's track record of beating its own outlook. I'm fairly confident that this outlook will be exceeded in next fiscal year. And the management did refuse to raise its long-term EBITDA at a steady state, which is $600 million. But with so much cash it has generated last year and this year, and more coming next fiscal year, I'm confident ATKR management will find more bolt-on M&As and increase its business to exceed its long-term EBITDA target of $600 million. So a quick update on the capital deployment in the first half of this fiscal year. $25 million spent on capex and $39 million spent on M&A, and $336 million for buyback, which I think is a good use of capital because we're going to see on the next slide its valuation is still on the cheap side. I have no update on the threats and opportunities I outlined before. So at $110 a share, its enterprise value is about 5.25 billion. That gives a EV over EBITDA of 8.7 if we use the $150 million quarterly EBITDA as a long-term run rate. Keep in mind that the forecasted EBITDA in the fiscal 2023 will be much higher than that, will be almost $1 billion in the whole fiscal year. If we use that as the denominator, then the EV over EBITDA ratio will be less than 6. And that is cheap comparing to the other peers in the industry, including Hubble and Emerson. That's why my original investment case is still valid. Energy Transfer also reported a very strong quarter. So at a stock price of $12 per unit, its EV over EBITDA is about 7, based on the EBITDA of $12.4 billion for this year, and that's $400 million more than its guidance given at the end of Q4 last year. So with the increased EBITDA outlook, I believe its whole year DCF will come in around $8 million. Keep in mind that the high DCF in last year was helped by the one-time event from Winter Storm Uri. The management raised the 2022 capex guidance by about $200 million. That's understandable because of the high oil and gas environment. So Energy Transfer will spend more money to do short cycle projects for fast return. Its 42-inch Gulf Run project will complete by end of this year. And in the 2023 and beyond, most likely Lake Charles LNG will take up a lot of capital investment as a major project. The management is targeting an FID by the end of this year. Energy Transfer also raised its distribution by 30% after 15% increase following end of last year. So despite the recent stock price increase, its forward dividend yield is still 2.1%. Now let's look at the cash flow situation. If the DCF in this year comes in around $8 billion, the outlay is about $2 billion capex and $2.6 billion of dividend. So that's 4.6. So Energy Transfer will still have $3 billion free cash flow left after paying capital investment as well as a dividend. That can be used for stock buyback as well as to further increase the dividend payout. I still believe the best use of the actual free cash flow is to buy back its units. However, the management seems to be fairly determined to further increase the dividend. And that's probably the second best use of its free cash flow. So at the current unit price of $12 per share, I think its stock price is still somewhat undervalued. Amazon also reported the earnings last week. First, a quick look at the trailing 3-month underlying order. So the automation solution order book is still growing strong in the high teens compared to 1 year ago. However, the commercial and residential solutions see a order deceleration in March, coming in at 7% compared to the low double digit in January and February. So in this chart on the left, we can see that the thin blue line took a dip towards the end of the first quarter. So that's something I need to watch out for. However, the management gave a more updated guidance for this fiscal year. In February, the underlying sales growth was guided around 7 to 9%. Now, 3 months later, the guidance was raised to about 9 to 11%. The earnings per share guidance was also raised by about 1%. So why is 2% additional sales leading to only 1% actual EPS? Usually with more sales, there will be more operation leverage and the earnings per share will actually grow more than the sales growth. The answer is although sales are strong, but the margin is under pressure. The sales is a reflection of the price increase, which slightly outpacing the cost increases. However, it does not maintain the same margin. As a result, the profit margin is gonna be a little less with the higher sales. Management specifically pointed towards the tool segment is softening. The automation solution backlog now stands around $6.4 billion. That's up $400 million from previous quarter. And the commercial residential solution backlog also increased by about $100 million. So the key takeaway is Amazon has pricing power to pass through the cost increase due to inflation. But its products are not in short supply as those from ATKR. As a result, its margin is being depressed slightly. Lastly, I'm going to provide an update on Mercado Libre. So based on its latest earning update, it increased its active users on its platforms to 80.8 million, up almost 16% year on year, although that's a slight reduction from Q4, which was high because of the Christmas and holiday shopping season. Its e-commerce segment in the last quarter was less than 60% of the revenue. That's because its fintech segment was growing much stronger. Now it's about 43% of the revenue. And also, its total payment volume of a platform grew 68%, as shown in the chart at the bottom right. That growth actually accelerated from 58% at the end of 2020 to 68% in Q1 2022. Why is this an important number to highlight? That's because the total payment volume of a marketplace means Mercado Libre's fintech products are widely adopted in the society, even for people who are not shopping at its website. And that explains why its fintech revenue has been growing so fast and becoming a larger and larger share of its total revenue. So for its total net revenue growth, as shown in the chart on the top right, it decelerated from 158% at the beginning of last year to 67% 1 year later. That deceleration makes sense because last year the pandemic was still raging, so people shifted their shopping more to e-commerce. And now with people getting used to the pandemic and also with the economy reopening in Latin America, that revenue growth has decelerated. However, it is important to point out in the latest quarter, Mercado Libre achieved almost 48% gross margin, comparing to 43% 1 year ago. That's because of the rapid revenue growth in the last 12 months, especially in its fintech segment. It's getting more operation leverage. As I pointed out earlier, its fintech segment is growing very spectacularly. Top chart shows the total payment volume in the acquiring and digital accounts. So the acquiring is related to the e-commerce, and digital account is just for people in their daily lives outside the e-commerce. So we can see both are growing rapidly, but the digital account has more than doubled compared to 1 year ago. So that's consistent with what I pointed out earlier about the total payment volume of its platform. Another highlight is its growth in its credit portfolio. So at the Q3 2020, its credit portfolio asset was about $300 million. Now it's almost $2 billion more. It's just an exponential growth. A key metric to monitor is the quality of its loan book. So that's related to a number called NPL, non-performing loan. So its NPL in Q1 of this year was about 28%, which sounds high. If we look at the historical numbers, NPL was 24% in Q4 of last year and 26% in Q1 of last year. So it's not a significant deterioration despite the higher interest rate environment. So I believe my initial investment thesis is still valid. At $950 per share, its price over trailing 12-month sales is about 6 versus 14 for Amazon.com before the pandemic. It has a wide moat from network effect and high switching cost. And that's evidenced in its growing take rate. So in its commerce segment, its take rate in the latest quarter was 16.7%, comparing to 15% 1 year ago. That's a slightly a reduction from the holiday shopping quarter of Q4 last year. And its fintech take rate is 3.84% in the latest quarter, compared to almost 3.2% 1 year ago. And that's also the same rate in Q4 of last year. Take rate shows its pricing power. So with the growing take rate and also growing revenue, its profit will grow even faster. Mercado Libre is doing very well business-wise. I feel confident to be a long-term stockholder. This concludes this episode of Quest for Twice. Until next time, happy investing.